topics are getting more complicated. We are analyzing more complicated capital budgeting issues in chapter 10 and 11. So if your fundamental is not strong, you will have difficulties. So make sure you are not getting behind. So before we start, if you have any questions, you can write in the chat box as usual, or you can unmute to speak. So if I don't see any, see or hear any questions, I will just continue the chapter 9 slides. Okay, I don't see any questions or hear any questions, so let's get back to the chapter 10 slide. So in this chapter, we are learning, you are learning about the cash flows of a new project. So to decide our ultimate goal in these 3 chapters, it's in chapter 9, 10, and 11, the main goal is to make a decision about a new investment project, whether to accept the project or reject the project. So how do we know whether we can accept a new project or reject a new project? So imagine you're working, you're having an internship in a large, in the CFO's office of a large corporation. And the CFO's office is preparing for the next, planning for the next fiscal year. So the CFO's office definitely needs to work with many business units in the corporation, and the engineers and division heads of those business units, they should have a plan for the next fiscal year. So how to improve, so how to make the company grow. So do you remember what was the goal of financial management of a corporation? Financial managers of a corporation, they are the agents of the principal shareholders. So they are supposed to be working to the best interest of the principal, the owners of the corporation. So an important goal of financial management is to increase the value of the firm's assets. So that's the most important goal. So how do financial managers increase the value of the corporation? By identifying projects, new businesses, new products, new services, new business models that make the company generate more cash flows out of the firm's assets. So business units must have ideas about generating more cash flows. So to generate more cash flows, they need usually need to invest in the new products, and new services and others. So there should be many ideas and proposed projects. And those projects, new projects, should be evaluated. And you are learning in chapter 9, 10, and 11, the tools. So in chapter 9, you learned 5 tools. And in chapter 10, you are using those tools to evaluate new projects. So there are 2 important inputs for the capital budgeting. So as you can remember from the previous chapter, the most important capital budgeting tool is the net present value method. So there you need 2 pieces of information to estimate the NPV of a new projects. What are those two inputs? First, cash flows. So what are the expected cash flows? So, and the second input is the discount rate. So to find the present value, you need the right discount rate. So how to find the right discount rate, you will learn in chapter 12, 13, and 14. So in chapter 10, you focus on finding cash flows. So where should you start to find the cash flows for a new project? So if you are working for the CFO's office of a large corporation, if your job is to estimate the NPV, you need to estimate the cash flows from the new project. So you will definitely need to work with engineers and division heads of the business units who propose the new project to develop what? Pro forma income statement, pro forma balance sheet. So pro forma financial statements you need to develop. And then what do you do? So using those financial statements, pro forma financial statements, you need to calculate cash flow from assets. So to calculate cash flow from asset, what do you do? Start from EBIT in the pro forma income statement and add depreciation, EBIT plus depreciation minus tax, you get operating cash flow. And what do you do? Starting from the operating cash flow, you subtract net capital spending, because capital spending will make available cash go down. And then you subtract change in net working capital. If net working capital needs to be increased, that will reduce the available cash flow. So cash flow from asset will be reduced by increasing net working capital. So this slide is explaining that kind of reasoning. So why do we have to consider changes in net working capital separately? Because the US accounting rule, GAAP, requires that sales should be recorded on the income statement when made, not when cash received. So net income is not equivalent to cash. So that's one of the reasons. Working capital adjustments should be made. So GAAP also requires that companies record the cost of goods sold when the corresponding sales are made. So whether suppliers actually paid cash, and whether corporations actually paid the suppliers or not. So current asset, current liabilities, so those needs to be, so that's another reason for working capital adjustment. And also, there is a similar inventory, inventory schedule. So in other words, the net working capital adjustment should be made to make sure that we are counting cash, not accounting net income. All right. So that's the previous slide explained why working capital adjustments need to be made to convert operating cash flow when we convert operating cash flow to cash flow from assets. So working capital adjustments and capital spending related adjustments are needed. The next slide, in this slide, explains another method of calculating operating cash flow. So one way to calculate the operating cash flow is EBIT plus depreciation minus tax. But another way to calculate operating cash flow is you start from the sales revenue and subtract all costs and multiply it by 1 minus tax rate, and then add the depreciation multiplied by the tax rate. So sometimes it depends on what kind of input data you're using. So this method is sometimes a lot faster. So it's good to know these two equations. So one equation, operating cash flow is EBIT plus depreciation minus tax. That's one method, and you learned in chapter 2. The other method is operating cash flow is sales minus cost multiplied by 1 minus tax plus DT. So DT, this term, depreciation multiplied by the tax rate. So this is called depreciation tax shield. So the reasoning behind this approach is depreciation is not an actual cash outflow, but depreciation charges reduces taxable income. So depreciation amount makes the company's tax amount going down. So the higher the depreciation, the higher the tax shield. So depreciation multiplied by the tax rate, marginal tax rate, will increase the operating cash flow. Yeah. So this formula, as this slide explains, very useful when we evaluate a project, and that project is about purchasing a new equipment, new piece of equipment, something like that. In that kind of case, this tax shield approach is very useful. So again, this slide is explaining the depreciation, repeating the depreciation tax shield amount I just explained in the previous slide. So how to calculate the depreciation amount? So there are two types of depreciation methods. One method is straight line depreciation. We just simply calculate the initial cost minus what will be the book value at the end of the project. So that's called the salvage book value. So the difference is divided by how long is the project period, so number of years. So that's the depreciation amount for each year. So in other words, every year during the project, same depreciation every year. So that's the straight line depreciation. And there is another depreciation method, accelerated depreciation method. So that's called the modified MACRS, modified accelerated cost recovery system. So there are different classes. So depreciation schedule is provided by this accelerated cost recovery system. So you just use the schedule percentage. So depending on which asset class this equipment belongs to, you find the right table for that new equipment and find that for year one, what's the percentage, and year 2, what's the percentage, and just calculate every year depreciation amount separately. So that's the MACRS accelerated depreciation method. So how to calculate? So the next slide is another important issue when calculating cash flow from assets. Again, when you purchase a new equipment for a new project, at the end of the project, the used equipment may have some market value remaining. So you need to consider the value of the used equipment at the end of the project, and if it generates a cash flow, definitely you need to calculate, you need to estimate it and include it in your cash flow estimation. So that's after-tax salvage. So if the market value of the used equipment is different from the book value of the equipment, then there is a tax effect. So if the salvage value, here I mean the salvage market value, is different from the book value of the asset, then there is a tax effect. So how to find the book value? Initial cost minus, and you subtract all the depreciation from the initial cost, and then you subtract all those accumulated depreciation from initial cost, you get the book value, and you get the you need to compare the book value of the used equipment at the end of the project with the estimated market value of the used equipment. That I call salvage market value. So you compare salvage market value is with salvage book value, and then if it's positive, you need to pay tax. So multiply the marginal tax rate by the difference, and you need to subtract it from the salvage market value. So the market value of the used equipment. So that's the after-tax salvage value. Or if the difference is negative, so what does that mean? Book value is high, but market value is low. So when the company sells the used equipment for a loss and incur a loss, that loss will reduce the taxable income the company generates from elsewhere. So they will improve, we will reduce the tax liability. So that means if this amount is negative, the whole thing will become positive. So after tax salvage value will be greater, can be greater than the market value of the used machine. So in short, this slide explains how to properly calculate cash flows from the used equipment at the end of the project. So that's that I call after-tax salvage. So far I explained the tax shield approach, depreciation tax shield, and after-tax salvage. So you may feel that, oh, this kind of discussion, explanation is too abstract. So conceptually, I can understand, but can I really work on those concepts without any problem when actual projects are given? So to make this abstract discussion more real and manageable, I included this numerical example. So if you understood the concept you learned in this chapter so far, you should be able to find the cash flows of this new project. So let's take a moment to take a look at this simple example. So this new project is actually a quite simple one. So we are not looking at a very complicated new project. It's just a replacement of whether this corporation needs to replace this old equipment with a new one. So if we accept this new replacement project, we are gonna buy, this company will buy a new machine. If we reject it, we will just keep using the old machine. So we will not buy a new machine. So that's this kind of simple problem. So here is an original machine. Okay. That had an initial cost of 100,000. So annual depreciation was 9,000 for this old machine. And it is when the company purchased this machine 5 years ago, the initial cost was 100,000. And since then, every year, 9,000 was the depreciation, meaning that this is just straight, we are looking at a straight line depreciation in case of this old machine. So 9,000 per year, so 5 years depreciation, so 45,000 was the depreciation so far. So that means that currently this old machine has a book value of 55,000, but it doesn't mean the market value with this old machine is 55,000. This is definitely market value can be very different from the book value based on the straight line depreciation. And today, but it looks like it looks like this old machine, if it's sold today, market value is higher than book values of $65,000. So that means if it's sold today, there will be a tax. For the $10,000 difference, there should be tax should be paid. So tax rate 21%. So that's where you need to apply the after-tax salvage, that kind of concept. But if we use this old machine 5 more years instead of replacing it with a new one now, this old machine is expected to have a salvage value of $10,000 after 5 years. And you are comparing this old machine with a new one. So, so suppose in the market you see a very better equipment competing with this existing old equipment. The market price of the new machine is $150,000. And this new machine, but it looks like this new machine has a much shorter life, 5-year life. And after 5 years, this new equipment will not have a market value at all. So salvage value is expected to be 0 in 5 years. But then why bother adopting this new equipment? Because the main reason it looks like this: if this your company purchases this new machine and replaces it, use it to replace the old equipment, there will be a significant cost saving, $50,000 per year. Wow. So initial cost is $150,000, but 1/3 of those initial equipment will be covered every year by cost saving. Oh, it looks like an attractive option. And also, it looks like the government is providing some kind of incentives to make this new machine that saves costs. So something like energy cost savings, that something like that, then it makes it eligible for accelerated depreciation. So this new machine, unlike the old one, this new machine is eligible for 3-year accelerated depreciation schedule. So that means this $150,000 new machine will make the company have high depreciation. So in 3 years, it's depreciated all. So that means there will be a tax benefit because of the depreciation. But depreciation is not an actual cash outflow, but depreciation, high depreciation makes taxable income go down. So cash flow will be higher because of the tax savings. And what if this company requires 10% return in this kind of a replacement? Should this company replace this new equipment by the new machine, or just keep the old one and forget about the new $150,000 worth of equipment? Yeah, so this is the question. Simple, easy to understand, but can you decide whether to accept the new machine or forget about this new machine and just keep using the original one? So if you accept the project, it means that the company will buy the new machine. But if you reject this new idea, the company will keep using the old one. And don't forget about the cost saving of $50,000 per year. So what are you gonna do? So if we are an intern at the CFO's office of a corporation, and you need to help the CFO's office to make this decision. So imagine that kind of situation. Everybody is busy with more complicated capital budgeting project. So as an intern, you're given a relatively simple analysis like this one, original versus new equipment decision. So this is the only slide, information you have, and you should be able to suggest the right decision. So what are you gonna do? So if you can, so you need, at the end, you need to take a position, accept the project or reject the project. And you should be able to explain why. So if, for example, if you suggest, I suggest accepting this project, meaning that buying this new machine, then the CFO will ask you why. And then you need to explain the reasoning behind it. So my question for you now is, don't look at the slides I provided in the next, the remaining slides. Don't look at those, and just take a moment to think about it. What are you gonna do next to find the right answer? So to decide whether to accept or reject the project. So you need to think on your own before you look at other people's work. So otherwise you cannot remember the complicated materials well. So take a moment to think about it. So while you think about this, I will take attendance. I will stop share, and I will copy the screen. Print the screen. And I will open my attendance file. Paste the first page, and then I'll go back to the Zoom, and then print the second page, and then paste. So I finished copying and paste those two pages. Okay, and then I go back to the June session. So make sure we have 30. All right. And then let me share the screen again. So what you need to do next using this information. First, you need to calculate, you need to immediately realize that you need to calculate the net present value of the new machine project. So to calculate NPV, what do you need? You need two things, cash flows and the discount rate. And the discount rate, 10% is given. So the second piece of information is already given. Then what's your remaining task? You need to estimate the cash flow from assets. So how long is the new, so you need to prepare the cash flow table, year 0, year 1, and how long should be the period. This is a 5-year project because the new machine has a life of 5 years. So you need to prepare a cash flow table for 5 years. Cash flow for 5 years. So cash flow from assets of 5 years. So what do you need to do next? So what's cash flow 0 and cash flow 1, 2, 3, 4, 5. So what's cash flow 0? So right now, initial cost of equipment, $150,000. So if you accept this new machine project, $150,000 is the initial cash outflow. And what should be, is there any working capital change? So for cash flow 0, there is no operating cash flow. So it's year 0, it's now. So there is no time to have any operating cash flow. So cash flow from asset equation, just operating cash flow is 0 for year 0. Just capital spending and net working capital component there, but there is no net working capital. There is only capital spending, which is 150,000. So in short, you need to make this kind of table. Oh, no, not here. So, yeah. So, yeah. So cash flow, yeah, 150, yeah. So 150,000 initial cost. And also you need to sell, buy. So this is coming from the new machine purchase. But there is another component. So if you buy the new machine, you need to sell the old machine. And you need to sell, if the new old machine is sold, right now, the salvage value today is $65,000. But is $65,000, do we need to consider all of the $65,000? Because you need to apply the after-tax salvage value component, because the book value and the market value are different. So you need to consider the after-tax salvage value. So that's where you need to consider the incremental cash flow and tax implications. So, and yeah, this is about, yeah, this slide. So year zero cash flow. So how to calculate the year zero cash flow? So you remember we go step by step from year 0, 1, 2, 3, 4, 5. So for year 0, the cost of a new machine is 150,000 outflow, but there is a cash inflow as well from the sales of the old equipment, because once we buy a new machine, the old equipment can be sold to recover some value out of the used equipment market. But don't subtract $65,000 of the salvage value. Instead, you need to calculate tax implication. So you need to calculate the after-tax salvage value, so which is $65,000 is the old equipment market value, but you need to pay tax but you don't pay tax for the entire 65,000. You pay tax for the difference. So book value is 55,000 and market value is 65,000. So for the difference, you pay 21% tax. So this 62,900 is the after-tax cash inflow from the sale of the old equipment at time 0, at the beginning of the project. So this is how to calculate the cash flow at time 0, and which is a cash outflow. So that's why 87,100 should be written there. So don't write just 150,000 minus 65,000. There is a tax implication. So that's how to calculate cash flow at times year 0. Any questions so far about how to calculate the year 0 cash flow for this new equipment project? All right. What about next? So there is no net working capital component. So this is the year 0 cash flow, the answer. And what about year? So before we move on to year 1, 2, 3, 4, and 5 cash flow, let's discuss this 10,000 negative component. So where does this come from? Net capital spending. So this is one of the complicated part of this. So at the end of the 5-year period, there is no salvage value of the new equipment. So let's go back there. So where does this $10,000 negative cash flow come from? So this new equipment has a 5-year life, and after 5 years, there will be no market value. So no cash flow. And also this new equipment is subject to the 3-year accelerated depreciation schedule. That means after 3 years, there is no book value remaining. So after year 3, no book value, and at the end of the project, no market value. So it sounds like there is no cash flow at the end of the 5-year period, the new project, the new machine, but the correct answer is negative $10,000. So $10,000 cash outflow, where does it come from? And that's where the concept of incremental cash flow becomes important. You remember the old equipment, if we do not accept this new machine, the old equipment would have been used for 5 additional years, and after those 5 years, the new old machine would have the market value of $10,000. And the $10,000 was lost, of the $10,000 of salvage value was lost because of that. And what about the book value? So that, in other words, you need to calculate the after-tax salvage value of the old machine at year 5 and consider the lost sales, lost value from the old equipment. But the salvage market value of the old equipment after 5 years, $10,000, that doesn't necessarily mean the actual cash flow loss is 10,000. We need to consider the book value after 5 years. So go back to this slide. So after tax salvage value of the old equipment was 65,000 today. And after 5 more years, there will be a depreciation, annual depreciation of $9,000. So that means 5 more years, there will be $45,000 of depreciation that will make a book value equal to $10,000. So book value and salvage value after 5 years happen to be the same, so $10,000. So tax bill will be, taxable income will be 0. So the after-tax salvage value of the old machine is $10,000. But if these two are different, you need to consider the tax amount as well. So $10,000. So if this new machine was not, if we don't purchase this new machine, then this $10,000 would be received 5 years from today, but it's lost because the old machine is sold at time 0 because of the new equipment. So that's why in this table, net capital spending related cash flow is negative $10,000. So this example, numerical example, explains the incremental cash flow concept well. So any questions so far? Do you have any questions so far? So if I ask you this kind of a question in the final exam, would you be able to answer that question? Yeah. So you should be able to. So if anything is not clear, you should ask. Yeah. Otherwise, if you don't have any questions, I will move on. So we overcome 2 important hurdles. So considering after-tax salvage for the old machine, new machine, and applying the incremental cash flow concept as well. So we feel cleared all hurdles. So the remaining question is to figure out the operating cash flow components for year 1 through year 5. So to calculate this, year 1 to year 5 operating cash flow, what do we need? We need to prepare pro forma income statement. So how to prepare the pro forma income statement for this new project? There is no sales revenue. So buying a new equipment does not generate additional incremental sales. So how can we prepare an income statement? We don't have additional incremental sales, but we have incremental cost savings. It's not additional cost. Cost is reduced. That generates positive cash flow. So cost savings. So in this pro forma income statement for this replacement problem, we don't start from sales revenue because there is no additional incremental sales, but we have incremental cost reduction. So that's where we start. So $50,000 of cost savings, positive cash. And then, so we start from sales revenue, but here 0, so don't write it. How about cost? Subtract all costs, but this time cost is negative cost reduction. So it's, the net impact is positive cash cost savings. And what do we need to do next? Subtract depreciation, but that depreciation is incremental. So again, you need to use the MACRS depreciation schedule. So year 1, year 2, year 3. So MACRS table. So the depreciation amount is for the new machine depreciation schedule, and subtract the depreciation for the old equipment. But you may wonder, why do we need to consider the old equipment depreciation amount of $9,000? Because again, the depreciation would have been there if we kept using the old equipment. But because of the new project, there is a change. So that's another concept of incremental depreciation. So here, incremental depreciation is this. So EBIT is calculated this way. So cost savings work like increased positive cash flow, incremental depreciation, that's negative cash flow. So EBIT is this amount, and we calculate tax by multiplying this by 21%. So it's the tax amount. So this is how to find, so this is how to find pro forma, how to construct the pro forma income statement. So we apply the operating cash flow equation, EBIT plus depreciation minus tax. So that's how to calculate operating cash flow. So any questions so far? So operating cash flow, and then we can use it using this summary. We can calculate the cash flow from assets, applying the operating cash flow minus net capital spending, and there is no working capital change. So after you have the cash flows, it's straightforward to calculate NPV and IRR using Excel or financial calculator. So when you use these numbers and do the calculation, the NPV is 75,478, so positive NPV project. So we, after this analysis, we conclude that it's better for this company replace the old machine by the new equipment. They can save cost. So this is how to apply the incremental cash flow concept to equipment replacement project. So we finished chapter 10. Any questions so far? So if you don't have any questions, we will move forward to chapter 11. Okay. So in chapter 11, we proceed to more advanced issues in capital budgeting. So first topic. So how to evaluate NPV estimates. And the most important lesson, looks like, is there anyone who has a question? I heard something. So if you have any questions, you speak. Otherwise, I will continue. Okay, it looks like no one has a question. So chapter 11 starts with evaluating NPV estimates. So the idea is NPV, you should remember that the net present value is an estimate, not the fact. So the reason is the net present value, that estimate, where does it come from? The net present value you calculated is from the estimated cash flows and the estimated discount rate. And both are estimates. So, for example, the cash flow estimate come from the estimated sales revenue and estimated cost. So let's use the previous equipment replacement problem. So we found that new machine has a project has a positive NPV. And what was the main driver of the positive NPV of the new machine? Cost savings. That was the source of generating value, right? But what if the cost saving was about the reduced energy consumption, but because of COVID-19? So suppose that analysis was done before COVID-19 last year, and it used the oil price prevailing last year. So that time in 2019, for example, nobody could predict COVID-19 pandemic. So the CFO's office last year used the prevailing oil price for the analysis and decided that the new machine will be adopted and old machine to be sold. But it turns out energy price goes down sharply, so there is no longer that cost reduction. So then it turns out the NPV estimates are not accurate after the fact. Yeah. So what I'm trying to explain here is when companies make capital budgeting decisions, there are uncertainties. So always remember that we are evaluating risky investments. So in corporate finance, when you're making financial management decisions, it's all about risky investment. So that's what I mean by evaluating NPV estimates. So in chapter 9 and 10, when you are learning how to calculate NPV and other payback and IRR and all others, and how to calculate incremental cash flows, you learn the mechanics, you learn the process, just like as if those are like mathematical procedures. But what I'm trying to explain in chapter 11 is, okay, you learn those tools, analytical tools in chapter 9 and 10, just like you learn math and statistics. So you learn the mechanics, what to be included, what to be excluded, and how to do the calculation using Excel. So chapter 9 and 10 are like technical, analytical methods you learn there. But in chapter 11, it's more like finance. So finance uses mathematical, statistical, and other analytical tools, but at the end, when you evaluate finance decisions and apply those tools, you need to remember that we are dealing with uncertainty, risky investment. So don't take those estimates at the face value. I'm not saying that it's not important to know those methods. Absolutely. It's very important for you to learn those tools, but don't rely too much on the single number you found, because by definition, that estimated number affected by a lot of uncertainty. By that, I mean, so hopefully now you understand what I mean by evaluating NPV estimate. So after you calculate NPV, you need to evaluate and look at the NPV, positive or negative NPV number as an estimate. And it can be higher, it can be lower, and depending on the change in assumptions. So we made a lot of assumptions. Remember, using the simple example you learned in the previous chapter, new equipment, cost-saving project. So the key, what was the driver behind that positive NPV project? That was the cost saving by the new equipment. Is the cost saving a very reliable number, or it can be much higher or much lower? What's the range of the cost saving in the previous numerical example? And you may want to develop different scenarios. So scenarios and other what if analysis. By that I mean it. So what if? So my point is, when last year the company did the cost analysis using the new equipment, if the CFO's office had people with more experience and knowledge in this analysis, meaning that completed learning chapter 11 and other advanced topics, and they have a more experience in this area, they would have done more analysis, like scenario analysis, sensitivity analysis. So what if the cost reduction is $30,000 instead of $50,000 per year? then watch the NPV, something like that. So under different scenarios, what if the cost saving is smaller, then under that scenario, watch the NPV. Is the NPV still positive, or how much goes down? So for each dollar of cost saving change, what's the change of the net present value, the sensitivity analysis. So sensitivity analysis versus scenario analysis is, sensitivity analysis is about one variable. Scenario analysis is about multiple variables changing. So those are differences. So in other words, sensitivity analysis is about a more simpler situation, just a change of one variable and how evaluate how sensitive is the NPV to the change in that variable. That's a sensitivity analysis. And scenario analysis, in a complicated project, there will be a lot of variables. Revenue may change, cost may change, and tax rate may change. So develop several scenarios based on the changes in all those variables. So, and then estimate NPVs, not just, so for the same project, you may have many different NPV estimates if you have many different scenarios for the project. Yeah. And again, this may sound like a very abstract concept, but it's about all about the real world. In this finance class, yeah, for example, many of you, I assume, was very paying a lot of attention to the result of the election. So last night, today, we have still a lot of uncertainty ahead of us. And in this kind of situation, imagine what kind of discussions are done in corporate management. So when they develop, corporations need to decide about new products and the new market approaches. So tax rate will be highly dependent on the outcome of the election, and also regulations, tariff, and there are a lot of uncertainties there. So when companies evaluate new business, new product, all those real world issues will affect the investment decisions of numerous new projects of corporations. So paying attention to the new information arriving at the market from politics and other areas, those news information have a large impact on the corporation's investment decisions and others. So yeah, so all right. And another topic you're going to learn in chapter 11 is break-even analysis. So break-even analysis, there are several types of break-even analysis. So you learn in this chapter 3 types of break-even analysis. So cash-based break-even. So break-even, by definition, benefit and cost becomes equal. So the simplest example is making a product and selling it. And there are 2 types of costs. When companies make a product and sell it, there are variable costs and fixed costs. So for example, a movie, a studio. So Disney, for example, wants to make a new movie. And there should be definitely production costs, and also, yeah, there should be production cost and marketing cost. And so the key is variable cost and fixed cost. So there is, whether the new movie sells well or not, the production costs are fixed. So huge amount of fixed costs. To recover those fixed costs, certain number of film, there should be certain degree of sales to the movie theaters and DVDs and other Netflix and other streaming services. There should be certain amount of sales revenue to cover the fixed cost. But there are also variable costs as well. So to pay more marketing, to hire more marketing staffs and to do like a promotion events, to improve sales, those costs, marketing costs may vary depending on the sales level. So fixed costs and variable costs are there. So how many should be sold to make the net income equal to 0? So that's accounting break even. But remember, net income is not cash. Net income is different from cash flows. So you may just focus on net income. So ignore depreciation, because depreciation is not a cash, actual cash outflow. So just focus on cash, and then cash-based break-even sales quantity would be probably different from accounting-based net income. There's also unit, how many products should be sold to make the NPV of the new project, a new movie, equal to 0. So NPV level, cash level, accounting level, break-evens are different. So in this chapter, you learn the break-even analysis, how to do the basic. Definitely doing all the details, you will learn in more advanced corporate finance courses, like Finance 3311. So all those advanced topics will be covered there, but at least in this intro course, you're gonna learn the basic 3 approaches of break-even analysis using this chapter, as well as connect practice problems. And also another important concept you need to learn in chapter 11 is operating leverage. So in finance, you should remember there are 2 types of leverage. So one is financial leverage, and the other is operating leverage. So first, let me give you a quick explanation of what do I mean by financial leverage. So financial leverage means the degree of using debt to finance assets. So in other words, financial leverage is about capital structure of the firm. So for example, if you are looking at a firm, looking at a simple business like a restaurant. So suppose you wanna open a new restaurant, Italian restaurant near campus. And suppose it costs $200,000 of capital to open a new restaurant, Italian restaurant near campus. 200,000 is the capital needed for the new business. And how to finance that new restaurant? Suppose you have $50,000. But you still need $150,000 more capital to open a new restaurant. So you may find a partner who can contribute $50,000 more. So you and your partner has $100,000 capital to open a new restaurant, but you still need $100,000 more. So you may find other partners who can contribute to more, or you can go to a bank and borrow $100,000 if you have a good credit. So if you decide to go to a bank and find and borrow $100,000, if you and your partner contribute $100,000 and go to a bank, and if you become successful persuading the bank to give your business a loan and borrow $100,000, and then debt equity ratio will be 1 to 1. So debt to equity, 100,000 to 100,000, so debt equity. But what if you feel, oh, this is too risky? So what if we cannot make interest payment to the bank? We may lose our investment. The bank may take over if our business struggles. We cannot make interest payment. The bank will take over. So we will lose our equity investment of $100,000. So that's too risky. So in this uncertain environment, we are not gonna take that route. So instead, you find another investor, another partner who agrees to contribute $100,000. So you start the business with all equity. The new restaurant with 200,000, everything is equity, then you don't have to worry about bankruptcy. Yeah. So that's financial leverage. So if you decide to, whether you decide to use bank debt or all equity, so that's about financial leverage. So using bank debt, that makes financial leverage becomes problematic, so capital structure. But here, you learn another leverage, another type of leverage. So operating leverage. So even if you start a business with zero debt, that means zero financial risk, financial leverage is zero, your business can still have operating leverage. So how? Fixed cost. So fixed cost works like a leverage. So fixed cost is another source of risk. So that's operating leverage. So suppose your business has a huge fixed cost. So for example, going back to the restaurant example, if you have a fixed rent, you need to pay. So even if you finance all the business 200,000 using equity, meaning that no financial leverage, if every month $10,000 of rent should be paid for the restaurant, the fixed, whether the restaurant has a lot of customers or not, that fixed cost will make the business go under. So that's the concept of operating leverage. But if all the costs are variable, depending on the sales revenue, the business is less risky. So operating leverage is about the business's risk, the asset risk, depending closely related to fixed costs, and financial leverage is related to debt versus equity. Financial leverage has nothing to do with financing method. Operating financial leverage has nothing to do with the business's characteristic. So financial leverage is entirely related to the capital structure. So financial leverage has nothing to do with the business's operational characteristic. But operating leverage has nothing to do with the capital structure. Operating leverage is about the cost structure, fixed cost proportion. So that's the structure of the chapter 11. So we will continue next week. But on Monday, we will start with the quiz on chapter 9. And tonight, the quiz tonight the chapter 9 homework is due, and continue work on chapter 10 and 11 homework problems as well. So if you don't have any questions, this is the end of today's class. So I'll see you Monday. Or if you have any questions, you can come to my office hours.